This is an example P&L of an actual real estate team that we do business books for. Okay. So this is a real deal. And this is one of my favorite reports to look at. It's called the trailing 3 months. If we just look at one individual month, it doesn't always tell the true story. And so 3 months, we're going to look back from January through March. So technically this is the first quarter of 2025, but always looking back 3 months. That's the report I like to take a peek at. So as always, when we do a P&L, we start with the income section. So let's look at total income of this team in those first 3 months was $438,000. Okay. $438,000. Now, one thing you'll notice right off the bat, and I think you need to be looking at this when you're looking at your income, is how much came from the owner versus the team. In this case, 60% is coming from the owner, only 40% is coming from the team. So it's a owner heavy business, meaning that owner is heavy in production. The team's also doing a good amount of production, but they're obviously doing the majority of that. And we can also see right off the bat that the majority of the owner's income that they produce came from listing side, and the majority of the team's income is coming from the buyer side. That's pretty typical, right? This is a pretty typical story of somebody starting to build a team and they're still heavy in production, kind of keeping things going. The reason that's going to be important later to know that those details is because depending on the level of production the owner is doing, we should have a different net profit margin. Somebody could have a 20% net profit margin and be healthy, and somebody else could have a 20% net profit margin and be unhealthy. What's one of the number one factors? How much production the owner is doing. Now, especially if they're not paying themselves like an agent, which I find most team leaders do not. So that's the first section is income. Then we have our second section, which is cost of sale, cost of goods sold right here. Now, again, so many of you are not tracking this in your books. Your bookkeeper is not a real estate bookkeeper, and so they don't even know this data, but you got to be looking at it. How much went out of the revenue that came in costs of goods sold or cost of sale? And so again, that's broken down into a few different sections. How much we paid out the broker, how much we paid out to buyer's agents and listing agents, and then how much we paid out in referrals, and then of course the total cost of sale. So about 41% or 181,000 went out in cost of sale. So we'll see if that's good or bad at the end here. But, I can tell you it seems high to me, and here's why. Because of the amount of production the owner is doing. When I see 41% going out in cost of sale, I'm thinking, oh boy, we are doing the majority of the production as the owner with zero cost of sale, and we're still at 41% going out. What happens if we were to step out of production and pay somebody else to do our deals? We'd probably be at 60+% cost of sale, meaning we only have 30 to 40% left, to be able to pay the bills and still have profit. We're running out of meat on the bone when I'm seeing 41% going out with the owner doing 60% of the revenue. Then we're going to look at your gross profit. That's what's left. So basically the remaining 59% or $257,000 was left in gross profit. That's the amount that actually hit this person's bank account. So again, one of the things I'll look at right away is, okay, 258,000. Well, how much production did the owner do? 263. This is not looking good, right? Because if I did 263,000 and after I paid everybody else on their deals and the broker costs and all that stuff, I'm only left with 257. Like, I'm not really doing a whole lot here as far as making money on my team. Like, my team is not making me any money. So there better be a strategy here long-term to fix that, because we're already set up to lose here. Essentially, if we were to step out of production, like we're losing money at this point. So that's an issue, I think, in my opinion. So we look at gross profit. So then we got to look at the operating expenses. How much did we spend? Well, let's look at that. The expenses start here and go down. The first category of expenses, there's three main ones, is lead gen marketing. They're at about 65,000 lead gen marketing, which is 15%. Okay, so we got 15% of the revenue going out in lead gen marketing. Second is people expenses. Total people expenses is 80,000 or 18%. Now, let's make an adjustment here. Why? Because actually the owner's also getting paid $22,000 in salary. I look at owner's pay, owner's salary, unless you're truly at the point where you're budgeting to replace yourself. To me, owner's compensation is really just profit that we paid ourselves in the form of a salary. So we really didn't spend 81,000. We spent 81,000 minus 22,000 we paid ourselves. We really only spent 59,000. And if we divide that by the total revenue of 438,000, really it's about 13%, not 18. Okay. So let's adjust for that. Then we are going to look at the third category, which is overhead. And if we go from there, scroll all the way down, and that's just everything else. 64,000. Oops, sorry, I'm writing this down and my pen just died. 64,000 or about, again, 15% going out in overhead. And what did I say for people expenses? 59,000 or about 13% for people outside of the owner's, salary. So 65 plus 64 plus 59 is 188,000. On paper, it's going to show that we spent 209, but again, or 210, but again, 22,000 of that was salary for ourselves. So really, we spent 100. If we were really adjusting for that, we spent 188,000, which should be 188,000 divided by 438,000. Our total revenue is 43%. Okay, so 43% operating expenses. And then that left us with, on paper, 48,000, but we need to take 48 plus 22 is actually 70,000. $70,000 in net profit when we adjust for that owner's salary, which should be 59 minus 43, should be 16%. Okay, does everybody see the issue here? Right off the bat, without even analyzing these numbers yet, we can see, oh man, the owner themselves did $270,000 in commission income just on their own deals. And they're left with 70,000 bucks. $200,000 of their money from their production went out to pay for this team. This is not where we want to be. This has to get corrected. Otherwise, you're just running a charity. You're not running a business. This team will be out of business or back to just being a solo agent if they don't get the numbers corrected. Now, the question is, what needs to be fixed? When we look at these numbers, let's just jot them down again. $438,000 of total revenue, $181,000 in cost of sale, which was 41%. Then we were left with $257,000 in gross profit, which is just the remaining 59%. So let's start with that. If we look at that right there, total revenue, the pie was 438,000. That was the revenue. We had to take 41% of that. So maybe something like in there, 41% went out in cost of sale. We were left with the other 59% in gross profit, the amount that hit our bank account as the owner. Okay, that's how the first piece of the pie was broken up. Then we had to pay the operating expenses. So the operating expenses, after we adjust for the owner's pay, was $188,000 in operating expenses, which was 43%. So that we were left with 70,000 in net profit, which is just the remaining, what did I say? 59 minus 43, 16%. So if we go back to the pie and make those adjustments, what we did then is, again, 41% went out in cost of sale. We were left with the 59% in gross profit. Then we took about 43% of that, of the pie, and we spent it to run the business. And we were left with 16% net profit in any owner's pay. This is not good, right? Now, could it be good? Maybe if the owner was 100% out of production. If they were paying 41% in cost of sale and spending 43% in operating expenses and keeping roughly 16%, it's not bad. I think it should be a little bit higher. I think we shouldn't be spending 43% on operating expenses, but our cost of sale would probably be a little higher if we were 100% out. But regardless, this person is not out of production. Remember, if we go back to the top, this owner did $264,000. So $264,000 came from the owner's production, and that was 60%. So if we look at the pie and we put in the owner's production, it would have been basically 43 plus 16. It would have been basically all of this was the owner's production. Do you see the problem? We are not running a profitable business. On paper, it looks like we are. We are not. We're losing money. We can't, this is not a sustainable model. So in this case, if I was this owner, I'd go in and say, we are high on cost of sale and we're high on operating expenses. We need to look at our operating expenses and get it as close to 30% as we can, meaning we're 13% too high. So we got to dig in and figure out where that money's going. In this case, I can almost tell you it's a little bit in each category. We're at 15% lead gen marketing, 15% overhead, 13% people. We should be at 10, 10, 10, most likely to run the model we want here. Then we got to look at our cost of sale because that's also too high. Sometimes it's just cost of sale. Sometimes it's just operating expenses. In this case, it's both. If they're at 41% cost of sale with him doing 60% of the production, we have a problem. And so we'd be digging up, we'd go back up to the P&L and we'd say, is it that I'm paying out too much to the broker? I don't think so. I usually see 5 to 8%. We're right in there. So I don't think that's the issue. Well, where else could it be? Am I paying out too much to buyer's agents? Well, let's look at it. $84,000 I paid out to buyer's agents. How much did they bring in just from the team? $150,000. That's 56%. I have a 56% buyer cost of sale. That's a little high. I usually like to see it between 48 and 50%. Let's look at the listing side. Listing side, we paid out to the listing agents $13,000. We divide that by how much they brought in, $24,000. We're at 54%. Okay, I think that's high because on the listing side, your cost of sale should be lower. It should be closer to 35%. Because if we're going to pay for all the stuff, we have an issue. We're paying too much to the agent if we're going to pay for all the stuff for the listing. We can't do both, right? Maybe we could get away with a 54% listing cost sale if the agents paid for everything, signs and photos and everything, staging, all that stuff. That's usually not the case. That's the whole point of them being on the team. But we can't do both. Otherwise, we won't make any money on every time a team does a listing. The other problem here is if we dug into what kind of deals these agents are doing on the listing side, my guess is they're doing more SOI agent listing deals, and we probably are paying a higher split on that. So that's what I'd be digging into. And then in this case, here's the other issue, referrals. Almost 12% of the revenue went out to referrals. This team is relying too much on referral business where there's a high fee to that referral company, and it's just eating into the profits. And then we got splits that are not making sense for us as a team. So those are the two places I'd be digging into. So the actions from this P&L would be, we got to look at where your deals are coming from on the listing side and figure out how to get that a little bit lower. Same with the buy side. How do we get your buyer cost of sale under 50% and your listing cost of sale closer to 35%? Okay. Number two is how do we get the team to do more company-generated lead deals, converted deals, company-generated lead conversion instead of their SOI. Because two things, SOI and these outbound referrals from Northway and the other referrals, because we got to pay a huge referrals fee and we got to pay the agent more on the splits when it comes from their own SOI. So we need a sales manager in place, or somebody, the agent, really, the lead agent should stop doing so much production and start focusing on sales management, holding the agents accountable. Why can't they do that? Because their splits are wrong. So in order to pay all the bills, they got to keep producing, which keeps them out of that sales manager role because they don't have time. So do you see how it all works together? And then again, the action is to go through and find 5% lead gen marketing we need to cut. We need to make sure we're not spending any more on people because we're 3% over. And then just all the other stuff, the overhead junk, we're at about 5% too high. So we got some cuts to make as well. So that's my analysis of this team. I hope it helps. We'll talk to you next week.